Welcome to another episode of Running Greenleaf, where we go through the nitty-gritty of operating investment real estate. Over the past few weeks, we've had a couple updates on CapEx projects. Last week, we talked about Parkwood Flex, which was a operating improvement deal we have that's in the flex space. We're very excited about kicking that one off. And today, we have another investment opportunity. Over the past couple of weeks, we've had quite a few coming out, and it's really because we are starting to see a turn in the market where there's lots of stuff coming up that fits right into our wheelhouse on what we can do and how we run our business. So today, we're going to dive into a debt opportunity we have, kind of explain a little bit what that means, and really where the opportunity is for us to step in and help with the situation and really generate some good, consistent cash flows.
Yeah, so over the last couple of weeks, we've gotten to know a lender whose balance sheet has really filled up and is lacking churn. The biggest thing that we're seeing with the lending environment right now is the lack of churn of their books. We were talking to another lender recently that's a multi-billion-dollar bank that has basically said they cannot issue any loans for 2023 or 2024 because deals aren't selling and their books aren't clearing off.
Yeah, overall transaction volume in the market is just down like 70%. And a lot of that is debt driven because rates are higher, so people aren't buying as much deals. But that also means banks are now like, how do we unload some of the debt we have, or how do we have turnover so that we can issue new loans? Most lending institutions are not like, hey, let's just hold this thing forever, right? They're just not going to hold a loan forever. They've got to turn it over. That's a lot of, in the multifamily space, Freddie and Fannie Mac, they're buying out a lot of the deals. That's their whole purpose, is adding liquidity to the multifamily segment. And if that's not there, then banks are stuck holding loans, and they don't want to do that forever. Right?
Exactly. So this private lender issues loans for lots throughout the United States. We're primarily focused on the territories that we do business in. Texas, Florida, Georgia, South Carolina, North Carolina, Tennessee. And we've looked at their books and said, we can help you offload some of these loans, and we'd be interested in buying these loans at a discount to their basis.
Yeah, and really, those are the markets that we've operated a lot of our mobile home type businesses in. This is a similar situation where you have a lender that has lots, right? And it's similar to what our lot game was in the mobile home space, where there might be a mobile home on that. There might be just some storage shed. They might have an RV on it. They may have built a cabin, or may have built a house on it. But essentially, someone who's bought a piece of land that then they're kind of doing what they want to go do with it. It's not an HOA. It's not like a pre-built community. What do you call the thing where vacant? The stud farms.
Yeah.
Right. It's not one of those. This is a piece of land where really individual could do whatever they want to do with it. Right.
And they really range from a tenth of an acre up to really 25 acres. And we've done our diligence and looked at the different lots that are available, have chosen to buy these lots.
Yeah, this lender has sold a bunch of these notes essentially to individuals all throughout the country. We're only buying a couple of the specific areas that they are in, but the notes are already performing. They're already paying. So we're looking at a situation where we're coming in and buying something that is performing. That way we can have day one cash flow, make day one distributions. We do not have a value add situation on the land. Our value add situation is really with the lender on how we're helping recapitalize what they're looking to do. For that, we get to buy them at a discount, and that's where we get to see the upside in the value of the assets that we're purchasing here. Yeah. Looking at the opportunity and how we're helping, really in our eyes, how we're helping kind of the lender in the liquidity situation is, we mentioned that deal volume is significantly down. So on the general partner side, on the sponsor side, you're looking at a real estate deal. You're thinking, well, okay, am I just going to do this deal with all cash, or am I going to go to a private lender and maybe I can save a little bit, or it's a little bit smoother than going through a traditional bank lending environment? Right now, people are trying to get creative in what that capital stack looks like. So on the capital provider side, which is a bank or a private lending institution, they're all about turnover. They need to be able to turn their loans because they're generating income, not only from interest income, but fee income on issuing new loans. So part of our deal is we'll be able to buy existing loans. We're going to be able to get them at a discount to the principal payment that is owed by the borrowers, provide liquidity to the lender, and then they'll be able to go out and go do more of these. Hopefully it comes back to us and we can buy more of them, but that could, looking at where the interest rates are right now, not necessarily People are kind of talking they might be coming down in the nearer future. So we don't know how long this opportunity actually lasts for, where the market opportunity is there to buy out the private lenders. But we see that as a very current opportunity.
Yeah, and it really comes down to timing, because the average loan that they're placing is a 10-year loan, and they're expecting their books to roll every 3, 4, maybe at the high end 5 years. And what they've seen over the last 18 months or so is that their books is not rolling over, and they're stuck with excess paper, so they cannot issue new loans. And by issuing new loans is how they grow their business and afford the size of their business. So we're really helping clear off the back end, their most mature loans on their balance sheet, to really help solve their problem.
Yeah, so average maturity of stuff we're looking at is around 7 years.
Right.
So a lot of the stuff that has been paying, it has been operating as a loan, and therefore we feel good. We know the payment history. We individually know the credits of the people that have each lot, and then we also know the locations of where the stuff is, and we're really doing it in the markets that we are familiar with. We get a discount on those. That's where we're able to generate our target on returns here, is being able to make monthly distributions, because we have very consistent cash flow, and then be able to hit 1% a month or 12% a year in cash distributions for the dollars that we're putting in.
Yeah, and another benefit that we also negotiated with this lender is that they'll guarantee the first 12 months of payments. So not only are these loans seasoned for a minimum of 6 to 12 months, is that they'll also guarantee the next 12 months of payments if they're in case of a default. The little default that they have seen, which is under 1%, has all happened in the first 3 months of issuing the loan. So we're buying kind of after that seasoning period and also getting that guarantee.
Yeah. So overall, we like this opportunity. It's not massive. We're not talking about tens of millions of dollars, but it is a unique position where we can come in and work with the lender to free up some capital on their side, and then in return getting what we see as a good discount to market on the value of a piece of debt. And then therefore we can generate consistent cash on cash returns with that. Our overall hold period, again, our average loan tenure is about 7 years. So this is a longer term hold where we're looking to generate that 12% cash on cash per year. So I'm sure there's lots of other questions and kind of how this goes into it. We're definitely going to, set up some different discussions that we'll have on how the internal workings of this are going to flow. But we have our investor deck out on this as well. We'd love to talk about any questions you may have, or kind of see what does this look like, and also how does this apply to the current market environment we're seeing and where things are going. So cool. Thanks for watching, everyone. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.